In this video, we are going to be looking at using the GDSR, and this is a tool that the banks are going to be using to decide whether you'd be approved or not for a mortgage. Another tool is the TDSR, which is a total debt service ratio. That's taking into account all of your previous credit card debts, student loans, car loans, all those other things, and the repayment plans that those are on. So this is just strictly looking at the money that's going out every single month in order to keep the lights on your house and comparing it to the amount that's coming in. So can the income that the household has support the expenditures, the monthly expenditures? So we basically want to fill in this skeleton, and we need the value to be at or under 32%. So we really want it to be at or under 32%. So let's take a look at this house. We see the monthly mortgage payments are $1,080, and everything has to be going into this monthly. The heating bills are $220 monthly, and the annual annual property tax. So what I would do is I would pull that aside and say, okay, $2,675. Let's cut that into 12 monthly pieces, which will give us $222.92 for monthly tax bills. So inside the GDSR, we're going to use that monthly amount, not the annual amount, because we need them all to be the same in order to compare. Again, our income is also given annual. So with a $75,000 household income, that gives us monthly income of $6,250 amongst all the people that are on the mortgage. So I would recommend that folks add across the top just to be on the sure side. Because there's something tricky that happens if we don't press equals after adding across the top. If you don't add across the top, it will want to do this division on you, which would give you basically a really big number in the end. But we want to add across and press equals so that we know that we have $1,522.92 going out every month and $6,250 coming in every month. So, and this is supposed to be shown as a percent. So that's where the times 100 is. So let's divide the top by the bottom and times it by 100 to get 24.4%. So the question really is, will you be approved? And yes, you will be approved. How do we know? We know that we're approved because we're at or under 32%. And this is a pretty solid number. So this is saying less than a quarter of what you make goes towards those basic household bills. Of course, if you're going to buy furniture, if you're going to have a car payment and all those other things, that's going to eat away at your TDSR. But just basic bills versus income, this family is approved.